Okay, cool. I think it's just past 9, so we can get going. I know there's lots of people who couldn't make it this morning, so we are recording the session, and I know some guys have to go earlier as well, Donald, so that will be recorded for you. But welcome to the second last seed coffee session for the year. It's a bit crazy how quickly the year went, and things are very interesting in the world, so we've got lots to talk about today. Obviously, Arjan is not with us this morning. He's on the road, but we've got some really good content for you this morning. We've got Ian on the agenda first up, so he's going to give us a bit of a market overview of what's happening in the world, what's happening in the markets, and then over the last few months, we've been on a really cool journey on the new shortlist with Tawanda. So we've concluded that, the last one, and today Migs is going to give us just a very practical implementation of how to actually use the shortlist. So it's very exciting. We've got lots to talk about, so I'm going to let's get right going. Ian, I'm going to hand over to you.
Great, Lisa. Thank you. Cool, guys. Great to see a few people here today. As Lisa said, we know not everyone's here, but we have got a lot to cover. We don't have all the answers, but let's give it a bash. So we've just keep putting this slide up. I think it's quite interesting. Obviously, we've had two very poor months as we end the third quarter. October's looking a little bit better so far. October's a notoriously tough month, but it already started August, September. So these are all dollars except for the JSE, which is in rands. If I put that in dollars, it's also going negative, close to what the Chinese market has done. But all in all, I mean, S&P 500 up 12% for the year, despite we've had two bad months. And MSCI global equity markets up 10% in dollars. Not too shabby, given everything that we've actually gone through this year. It's been a crazy year so far. So yeah, that's just always interesting. Also, just to see the sort of month-on-month volatility. But we'll actually look at that over an extended period as well. So what I want to do here, and we can jump to the next one, is just to briefly look at this geopolitical. Now, these are just really factual comments, and I'm just going to preface this by saying these are none of our views per se, but we do get this commentary and analysis from BCA, and they have a geopolitical analyst. These guys understand this thing in depth, in detail. They haven't just been looking at it now. They've been studying and know the ins and outs of what's happening geopolitically. In depth and over many years. Whether it's not always easy to. I'll just also preface this by saying it's not that simple to extrapolate straight into what we need to be doing from an investment perspective. But anyway, this is some of their points that they gave us on a webcast just this last week. So I've got 3 slides. The first is, okay, we've got Israel's mobilizing tons of troops, 500. It's a big percentage of their population, 5% of their population. Obviously, a lot of those are sort of the reservists that they call up. Primary objective, dismantle Hamas. There is a risk that this escalates in the north with Hezbollah. Their view is Iran is feeding these proxy forces. And at the same time, Iran, as we know, has been building nuclear capabilities. In fact, they mentioned the date 18th of October, which happens to be today. The UN sanctions on Iran missile and drone prohibitions expires. What does that mean? It means actually, if it doesn't sort of get extended, Iran will just be able to trade a little bit more to be able to get additional missile parts, and which is a boost to their missile program. They put this interesting chart up. It's the stockpile that Iran has been building of uranium, and they've got a ton of 60% enriched uranium, 536 kilograms of 20% enriched uranium. According to their analysis, this is sufficient to build 6 nuclear bombs in 1 month. So this is a big potential risk. It's not new. It's been going on for a long time. Okay, these are the facts, some of the facts that they put out. Some of their views and points on Iran. Iran is a revolutionary force, fundamental driver of the regional instability. They want to ultimately change the political order within this region. It is a mountain fortress as a country, just by virtue of its geography. So it's unassailable from ground troops. It's a population of 88 million people, sophisticated people, even though they have been isolated through obviously sanctions. They could start to dominate the region, especially if they do attain the desired nuclear weapons that they're trying to be building. It's, according to them, it's the only Middle East state capable of creating a regional empire. And obviously this is the big concern for the US. Obviously, there's a degree to which they're backed by Russia and China. And it's also why Saudi Arabia and other Arab states such as UAE were negotiating with Israel to try and normalize relations. Obviously, we saw that Saudi Arabia pulled out of that now, post these attacks. But there's a couple of other countries, UAE is one of them, that has sort of tried to normalize relations with Israel. And that could have been the catalyst. That was one of the catalysts. The third slide on this is obviously, okay, pertaining to oil. We've obviously had an issue with oil price, and we've all felt that with the rise in petrol. Part of that has been obviously the Russia curtailing supply, pushed up the price. At the same time, though, generally, with weaker economies, especially maybe China, to some extent, the demand has been on the weaker side. But the curtailment of supply is a problem. So the US, is obviously trying to continually negotiate with Saudi Arabia to just try and get more supply out and get OPEC and Saudi Arabia especially to sort of up the supply. The US has these strategic reserves. They're down to 350 million barrels. This is a chart on the right-hand side there of their strategic reserve pile. But in order to suppress some of the pricing increases, they've drawn down quite substantially, as you can see there. So it's been building up for a long time, up to about 750 million barrels. It's drawn down quite substantially from a 4-month import to a 2-month import. So there's been a big drawdown, which is not a fantastic position. So according to them, I mean, the US room for maneuver is a little bit, it's on the smaller side. Obviously, their big concern, especially from the Democrats, is that, they don't want to see massive oil spikes going out. It's not good for the incumbent Democrat re-election next year. So higher prices are obviously negative for them. Obviously, the Middle East, could and has already a little bit to some extent led to some oil shocks. It's not been massive at this stage, but I mean, if this thing escalates further, clearly that's negative for all consuming economies. I say consuming economies of oil, and that's I think ultimately the big one. Oil is a fundamental input, and most countries are obviously on the consuming side. It's obviously a chunk of the oil comes from the problem countries now, obviously Russia and clearly the Middle East. So those are 3 slides. I thought I'd put those points up. It's interesting and fascinating to listen to. It's not always easy to actually put that into, how do we look at it from an investment perspective. Okay, some other points pertaining to interest rates and debt levels. And these are things which are obviously always top of mind. So the first chart is US government debt levels. And I've sort of titled it, is that a problem? Is it a problem or not? And at face value, I mean, these are huge and crazy numbers. I mean, this is the US federal debt. It's the government debt levels. They're now at 33.5 trillion. And it moved up $500 billion in 25 days. I mean, these are just numbers that we cannot absolutely fathom. And since 2008, the government has added 24 trillion. It's up a phenomenal amount. I mean, and there's the chart there. It's just up and up and up. If you recall back a few months, we had the debt ceiling, and since that debt ceiling crisis, which is where, each point in time they say, here's the level, and then they've got to go through Congress to actually up the ceiling, we're already up 2 trillion. And there's no cap until January 25. And the sort of question mark is, how will that US debt be in January 25? But the last point there is, it's not always that obvious that this is a major issue. I mean, this is not a new thing. It's been on for so many years. The US has got a huge amount of debt. I'm not saying it's not a problem, but it's not always simplistic. It may be simplistic to say that it's a problem today. At some point it could be, but this is not a new issue. It just keeps on going. It makes for headline news, but it's not always that obvious that this is a problem that we suddenly have to be so scared out today. So that's on the US debt. The other issue, which is the big one, is inflation. I've put this chart up there, and you might not be able to fully read it and see it, but it's quite useful. This is all the central bank interest rates there, and I've just highlighted South Africa, juxtaposed against the inflation. And there's no question that for the most part, and the red there is central banks hiking rates. Central banks have been increasing interest rates to try and squeeze down. But it's squeezing down. They're trying to squeeze down demand, but it's not helping. They can't do anything on the supply side. Supply is obviously supply of goods, and obviously we spoke about the oil. If oil supply is being constrained, that's problematic, and that's not something necessarily that monetary policy, i.e., higher interest rates, will solve. You can push up interest rates, but if Russia and the Middle East are squeezing down the supply of oil, it's still going to come through as inflation. But the goal, the monetary authorities, i.e. the central banks, really only have one major tool as the interest rates, and their goal is to restrict wage increases, cause a degree of economic harm. It's to try and squeeze down, as I say, that demand, to try and squeeze out inflation. Ultimately, it will work, I do think, but you also need supply to come on. Anyway, what is interesting is that for the most part, for many countries, the green there is real rates. So actually, you've got central bankers being pretty tight on their interest rates. Here you've got a long-term chart of interest rates, and this is an interesting one because it's the average of corporate interest rates and personal interest rates in the US, and the 30-year mortgage bond. 30-year mortgage bond is obviously the bond that the mortgage rate that consumers take out to purchase homes. The combination of these over many years, from the peak of the last major inflationary period, which was the 1970s all the way to the 1980s. From that peak, it's been down. It hasn't been an absolute just a one-way downward move. There's been these upward spikes, but you can clearly see that this last period of this last bit of time now has been a big spike up. So this is potentially of concern. So far, it hasn't. It doesn't appear that it's had a lot of negative impact, but maybe it's still early days. We do know that at each point in time, when you have these big spike ups, the grey lines there are recessionary periods. So far, we haven't had that, and the jury's a little bit still out. And this recession has been pushed back and back and back. But it is concerning that this is a huge spike up in interest rates. Juxtaposed to that, I want to also highlight the fact, and this is something I came across, and it's quite interesting. It's a complex chart, but basically, I just want to highlight that at the private sector, these are private companies. These are the companies that have debt, and it varies from country to country. And it's not necessarily a universal issue that corporates are overly indebted. And in fact, I've highlighted the states there. So that's the percentage debt as a percentage of GDP, 153. And then the right-hand chart there shows, how has that moved over the last 10 years? And for the states, corporates have not got more indebted. So corporates and individuals have not got more indebted. Yes, interest rates now are up, but it's not like we've got a huge amount more of debt. So I think if you look at the debt levels, the governments have got the debt. As we saw on that chart, the governments have got massive amount more of debt. Corporates and individuals are not necessarily that much more indebted. There are some that are on more red flag there. China is the one that stands out there at 63. So that's the delta. They call it the delta. That's the move up. So if you take the trajectory from over 10 years, individuals and corporates have got more indebted. So it's trying to just balance the two. At the same time, and this is something we've been saying for a period of time as well, and that pertains, as we know, for individuals sitting here in South Africa and sitting around the world, is that high interest rates are not necessarily always a bad thing for savers. And this is a chart of money in US money market funds gone up $1.5 trillion over this shorter period of time from last year. Obviously, the higher interest rates are attracting money, and it's beneficial for savers. This is not only for individuals, but obviously corporates as well, who sit with a good chunk of cash on their balance sheets, are benefiting now as well. So that also plays into the fact that corporates and individuals are not necessarily that highly indebted. Yes, interest where you do have high debt levels for individuals, where they're having to pay, where they've overextended on their bonds, and obviously corporates who've overextended on their gearing. They are obviously the ones who are going to be suffering, especially when they're going to have to refinance their interest rates at these higher levels. And at the same time, this is the long-term chart of the US dollar against its trade-weighted basket. It's a busy chart, but it's the last point there, or the last couple of years, the dollar's been on the strong side, and maybe there's a lot of reasons why it has been. Partly because we've got these higher interest rates it's supporting, partly because the rest of the world is not that a great place to invest in. The emerging markets generally, China problems, Europe problems. Money has continued to go to the US. The higher interest rates attract the better returns, as we've seen there, have attracted money. So, again, I just want to sort of allay the fears. It's not a matter of, the US government has got so much debt, the dollar is about to just collapse into a heap. It's not that straightforward. There could well come a time, obviously, when the dollar finds itself on the weaker side. We'll have to see how that plays out. But if we recall back, and this is what we've been saying, right from the beginning of the year, there was a lot of concern about the US dollar, but it's on the strong side when it's relative to its trade-weighted basket. And obviously, we know sitting and we look at our rand versus the dollar, we know we've obviously seen the dollar appreciate pretty strongly. I think it's around about 10% this year, appreciation of the dollar against the rand. So all these factors are playing into a reasonable amount of dollar strength. Just got a couple of charts just to end up on the global equity markets. No, go back one. So this is I just updated this chart. I did put up a couple of months back, and again, this is from our BCA guys. It's basically the equally weighted S&P index. So it's basically just saying, if we just equally weighted as opposed to market cap weighted, and I'll elaborate a little bit more on that. It's not that obvious that it's just a one-way bet up for the S&P 500, i.e. the US stock market. It's been a little bit more choppy, a little bit more sideways actually for the last couple of years. So that's actually taking into account equally weighting all the businesses, as opposed to the next slide, which is the domination by, what they call the Magnificent Seven. I mean, this changes a little bit from time to time, but the big tech companies, i.e. Apple, Microsoft, Google, Amazon, Nvidia, obviously we've seen Nvidia, Meta, which is obviously the Facebook, and Tesla. These are the names that have pushed that because of their higher market weight and dominance in the S&P 500, have really pushed that S&P 500 index. And by virtue of the fact that the S&P 500 or US has got a high weighting in global markets, has helped push up. So it's been very, very concentrated in a way in terms of the concentration. So if you own a degree of those stocks, you've participated. If you haven't, it's been a little bit more choppiness, a little bit more sideways, a little bit not so fantastic. And these are the percentages, so the weight of those companies in the S&P 500. So close to 30% is the weight of those 7 companies. It's a big weight. Remember, if we look back, we all have always said, on the JSE, you had some dominant names in the past. It was resources, and then you had the Naspers debacle, Naspers process. Oh, it's such a big weight. And the thinking was, well, if you go to the S&P 500 or something, it's a lot more evenly spread. Well, you can see that over this period of time from 2013 all the way to now, that dominance of certain companies has escalated up quite a lot. Anyway, it's something that when it's working nicely. We just have to watch it. Okay, last couple of slides. I think with everything, with debt, with geopolitical, there's always something to worry about. This was a Bank of America survey summary of clients' biggest market risks. And these are institutional clients. And at each point in time, there's always something weighing on their mind. What is of concern? I mean, is it the European sovereign debt crisis going way back? That was a big one. The US fiscal cliff, same story. That, as I say, that the fiscal cliff is the debt levels is too much, and so that's going back 10 years now. China hard landing, other geopolitical crises. If you look back at 2015 and you Google geopolitical crises, I mean, there were 10 major geopolitical crises, all very relevant at that point in time. Brexit, Trump, I mean, it just goes on. Obviously, we had the COVID. The last couple of years, we've had the inflation issue and we've had the interest rate hike issue. All relevant, all issues, no question about it. But these are things that the market is always worried about. So then I'm saying, okay, it's not a straightforward ride. And here you go going back 30 years on the S&P 500 again, and it's the drawdown period. So each point in time, yes, have you had big drawdowns? You've had 10% drawdowns. You've had a chunk of time when you've had 20% drawdowns, and you've had some bigger drawdowns, especially in the global financial crisis, and obviously even the last couple of years, especially when we had the COVID pandemic, and then even this year, 22, with the Russian debacle, Ukraine debacle. So we've had these big drawdowns, but for those investors who've even just been able to stay the course, and it's not that easy, and that comes into allocation, 100,000 has compounded up to 1.7. That's around about 10% compounded return over time. And that's including, obviously, these big drawdowns. If you just adjusted inflation, and I've just pushed it up to about 3%, I mean, your 100,000 is 2.5 to 242,000. So you've been compensated for ultimately taking on these risks. There are always these risks out there, no doubt about it. there's always something to be concerned about. So I'll leave you with this thought. You might have seen this. Think like a farmer. And the farmers don't shout at their crops. They don't blame the crop for not growing fast enough. They don't uproot their crops before they've had a chance to grow. They choose the best plants for the soil. They irrigate and they fertilize. Obviously, take out the weeds. And they know that they're going to have good seasons and bad seasons. And the weather, well, the weather's maybe like the geopolitical environment. You can't control the weather. We have to be prepared for it. Obviously, that's where the proper financial advice comes in, the proper asset allocation for the clients. So thanks, guys. I'll leave you with that. We can chat about any questions. I hope we'll have enough time. I'll hand over to Lisa or Migs. Are you going to just take it from here?
Yeah, I'm happy to take it from here.
Thanks, guys.
Perfect. So I think we've definitely all considered before wanting to be a farmer. I'm sure I'm not alone in this room in terms of that, and just forget about the worries, forget about everything. But realistically, I'm probably not going to be a very good farmer, and my crops won't survive. So wouldn't work for me. But guys, so on the seed shortlist implementation, I'm going to take you through obviously the way you can practically apply this. As you guys know, Hereford and Hampshire, you guys both have access to your DFMs, Hereford and then the Hampshire DFMs. But for this particular exercise, we're going to focus purely on implementation of the funds from the various sections. So on the slide here, as you'll see, all of you guys have many clients. I mean, I've spoken to some of you and you have about 300-400 clients. But the reality is that when you have one client, you actually have various different strategies that you're working with this client. Generally, most advisors start their client off on an emergency savings or an emergency pot, and that we're looking at about a 3 to 6 month time horizon. If they've got more money, we then look at their retirement savings, and this comes in various parts. We've got the tax-free investment, which we often encourage you guys to keep it as a long-term vehicle for your clients. You've got the Reg 28, so that's obviously your pension preservers, your RAs, etc. And then your discretionary investment, which is always great, especially for those clients that can afford to do that. And while that's all going on during step 1 and step 2, step 3 weaves itself between that, and that's specific goals. You've got your younger clients saving for a down payment on their car, wanting to put a payment on their house, go on an overseas holiday. I think many of us would love to have purchased a ticket to the World Cup final happening in a couple of weeks. So that goes through that in that process. So if we keep this in mind, the goal here is that you're going to be assisting your clients across the various stages of their journey. And I think ideally we would wish we'd have clients that had enough money to be able to do all steps 1 to 3 from the get-go. But you're probably finding yourself assisting the clients with one or 2 of these steps as opposed to all of them at any given time. So when it gets to determining what their strategy is, if we go to the next slide there, comms, is how do we go about building the strategy for the clients? And the first thing is, what framework do we use? So before we even get to step 2, the first thing to look at is understanding the investment strategy of the clients. One of the key aspects which I always talk about is understanding your client's time horizon. We speak about your risk analyzer, and I think I've hopefully never will be quoted, but I think I've said that's a load of rubbish. But the risk analyzer will often tell you the client's willingness to take on risk, but their time horizon really determines their capability to take on risk in your growth assets. Next, it's understanding your client's investment goals, what it exactly is that they are wanting to save towards, what is their goal, what they're saving for, what the expectations are, and then their psychology. And I think a lot of time life can get busy, and trying to focus on what they're saving for is important, but their mindset around that is just as important. So when they go on this journey, if you've got a client investing into equities, what is their view of what that looks like? And your goal as the advisor is to set them up from the beginning to know that this will be a bumpy journey. If they're going into pure equities or offshore, they'll have 1 or 2 years of underperformance. But what is the expectation? What have you communicated with them around that strategy? And then the second step in that is identifying the correct fund solutions for this. So once you've determined their time horizon, you've determined their goals, and then you've determined what their mindset is around their investments, you're going to start to look at the strategy. And that comes to the fund implementation. What funds would you use in order to help these clients reach the goals that they need to reach? So guys, the next slide that Lisa will pull up in a second, and I'll start chatting on it, but it's that slide you've all seen before that we went through in the investment fundamentals workshop, as well as that's on the shortlist on a monthly basis, and that's the investor strategy framework. Now, guys, I will say this until I'm blue in the face, but this is such a great resource, and a lot of it you understand and you know, but I really encourage you guys to use this as a tool for your clients to show them and manage expectations. We can see that if your client tells you that they want to invest for 3 years or less, they are going to be going on the conservative side, and that return expectation is inflation +1. We've all had those clients before that tell you that they want to save 100,000 Rand and purchase a car next year for 150,000 Rand. And we know that's an unrealistic growth expectation, but they may not. So this is a great way to explain that to them. So we're now going to move on to the practicalities of this. And if we move to the next slide, we are going to be working with Mr. Sia Khaleesi. I think he's quite topical at the moment, but probably after last weekend, Mr. Cheslin Colby would have been a better example with his heroic conversion stopping dive. But Mr. Khaleesi over here is a 35-year-old client. He's wanting to start his investment journey, and he has 5,000 Rand to invest. Clearly, the Springboks aren't paying him too much. But what we're going to go with here is we had a chat with him, and his priorities of investments is he's determined that the tax-free savings is where he wants to focus the first bit of his investment journey. He then wants to look at an emergency fund, followed by his retirement savings, and then his discretionary side of investments. So if we look at the shortlist, which we'll see in the next slide, this is an extract from, I think it's page 4 of the shortlist. We know that for his tax-free, and we're using this for a retirement vehicle, we're probably going to be looking at long-term aggressive. So that's 10 years plus on the investment journey. Now, if you've ever had a chance to look at the shortlist, and I hope a lot of you have, but you'll see that we've got everything from your local flexible, your local equity, your offshore flexible, and then your offshore global equity. And guys, I really want to stress the point that this is such a great resource for you, not just on the fund selection, but we've given you the rationale of each of those funds. So when you communicate with your clients, when you're trying to explain why those funds on their portfolio, we've done the work for you. We've given you a one-liner as to why that fund's in the portfolio. So taking this list, we built his portfolio for him, and the fund that we've looked at for the recommended side is a blend of 60% to active managers and 40% to low cost passive trackers. One of the things that Mr. Khaleesi made clear was that he really wanted to go active, but he also wanted to be saving on costs. So those of you guys that have used these funds before, you know Fairtree is a great manager, 5% outperformance after fees over the past 8 years. So that's 30% of the portfolio. We've gone 20% to an LC40 tracker, 30% into seed global equity. I think we've stressed the benefits of that many times from the diversification of the underlying managers, as well as the structured products that we have available in that fund. And then we cap off this portfolio with an MSCI World Equity Tracker. And before we move on to the next slide, I just want to highlight that point. When you guys do go the passive route, we generally recommend that you go as broad as possible. So your MSCI World, your global equities, as opposed to going specific into your tech shares or your fourth industrial revolution. Not to say that those funds don't perform well, but the problem is that when tech does badly, you're really going to feel it. So if you're going to go tracking, if you're going to track something, rather track a broad index. Then next, we're going to look at Mr. Khaleesi's emergency fund. This is obviously short-term, 0 to 3 years. So we're looking at something that can be stable enough that we're not going to see big swings when the market moves sideways or up and down. But we want to be in a place where if the client has an emergency, their gearbox falls apart, their kids need a deposit for a holiday, anything like that, this is where they would go for that solution. And for Mr. Khaleesi, what we've done for his portfolio is we've gone 100% into seed income fund. Now, this may seem like a biased decision, but I would want to remind you guys that in the seed income fund, if we go to the next slide, you get such diversification within that portfolio. So although your clients on their statement will see seed income, the underlying strategies are things like Prescient Income Plus, to Quanta Active Income, Ashburton High Yield Investment Trust, and then direct bond holdings. And those of you that have used this fund would have seen that you've been getting good 1-year returns of around 10%, and the forward-looking yield for this is sitting at 11.5% for the seed income fund. Then moving on to his retirement savings. Now, just want to show this to you guys again. If you have a look on the last 2 sections there, we've obviously got moderate and aggressive. But as we know with Reg 28, in other words, the Reg 28 tells us maximum 75% equities and max 45% offshore. We're probably fitting somewhere between moderate to moderate aggressive. And if we look at that return expectation, your client can expect inflation plus 4 to 5%. So we're probably slotting between those two risk categories there. Again, looking at the shortlist, these are the funds that you have available to you. This is probably on the shortlist the most funds available in terms of the risk categories. But I think what's important to understand here, guys, is that we've obviously provided the funds that perform well and are likely to perform well going forward. And you are more than welcome to take these funds and create blends that you feel fit. But I really want to encourage you that if investments is not your forte or it's not your focus, rather make use of the blends we provide. A key example here is if we look at Allen Gray Balanced, really great fund, had some great performance over the last few years, but it's a contrarian value fund. What that means is that generally the Allen Gray Balanced Fund will do something different to what the rest of the fund managers in that category are doing. So if you weren't aware of that, likely what you would have done is maybe go 50-60% to Allen Gray, but it actually works well as a blending fund and not as a major component within your portfolio. So looking at Mr. Khaleesi's retirement pot, what we've done there is we've taken an extract directly from the shortlist, and I think it's on page 6 of the shortlist. You'll see if you read down the columns, you've got 3 different blends that we've recommended. And as mentioned earlier, Mr. Khaleesi is quite cost sensitive. So when we had showed in this portfolio, 50% of the portfolio is in 2 very low cost funds. One being prescient balanced and one being that Net Group Invest core diversified. And if we look at that from a TIC perspective, that's sitting at below 0.51% on 50% of the portfolio. So with these different blends, we really are trying to provide ways to blend these funds that work well, that diversify, have negative correlation, but also provide for the different needs of your clients. Then the next exercise here is discretionary savings. Now, generally, this can be something quite straightforward. If it's discretionary, it's a long term, the client wants to invest the money for some goal in the next 7 to 10 years. You would normally go pure equity, offshore and local. But Mr. Khaleesi had 2 things at play here. One, he mentioned that he wanted to stick to the moderate aggressive risk profile. But second, he had mentioned that in the next 5 years, he's probably going to need to access some of that money. So as we know, if we had to put Mr. Khaleesi directly into just equity funds, there's a chance that if we decided to draw money from it in the next 2 years, that might be drawing from negative capital. So what we've done here is we've gone with the strategy 2 barbell growth approach, which is on page 7 of the shortlist. And what I want to bring your attention to is that 20% of this portfolio is sitting in conservative income funds, and that would be the first place that Mr. Khaleesi would draw from if he needed to access some of that money. We then, on the other side of the barbell, we've got a mix of aggressive local equity and flexible funds, as well as your direct offshore equity through Old Mutual and Seed Global Equity. In the middle of that pot, we've got your moderate aggressive funds. We've got ABAX, Prescient, and Coro, and this almost serves as that buffer that if the income funds get drawn out, you've now got those moderately aggressive funds to draw from. Then looking at the next slide over there, we're now playing a bit of not back to the future, but time travel. It's now 8 years into the future. Siya Khaleesi decides that he wants to sell his 2023 World Cup winning shirt for 500,000 Rand. And I think everyone in this room can agree. We hope that it's one of many shirts over the next 8 years that will be winning. But he decides he wants to invest 500,000 Rand and take advantage of his annual 1 million Rand allowance that you can take directly offshore into hard currency. He's then also indicated that he wants to save an additional 2,000 Rand a month offshore as part of his retirement planning. So if we go to the next slide, when it comes to direct offshore funds, this is a shortlist that we do send out. And if you do want access to it, we can get you onto that mailing list. But basically, these are your direct offshore funds that are available on various platforms like Innate, Glacier, Allen Gray, 91, etc. So looking at these direct offshore funds, we've got recommendations from your income section, your conservative, all the way through to your pure offshore equity on the aggressive side. Now, if you've ever had a conversation with myself or Adrian, you'll know that we've told you many times before, we would recommend that if your client is going to go direct offshore, you probably want to go as aggressive as possible if it's a long-term investment. Now, historically, other than the last 2 years, your income funds offshore haven't been giving you too much benefit as opposed to keeping that locally. But with interest rates increasing, you do get a bit of value for that. But that would only be recommended if your client is going to be using that money in the next year or 2 years. So if we go to the next slide, you'll see here that in that first section there, for that 500,000 Rand lump sum that Khaleesi is going to be taking directly offshore, the first thing you need to determine is what structure are you going to use? Are you going to go directly into a list? So your Innate, Glacier, Allen Gray, or Stanlib offshore, or are you going to go into a life wrapper like an endowment or a sinking fund? Now, for those of you that have had conversations with us, we generally recommend for tax purposes, an endowment works as a great structure to put your clients' money in for offshore. They're capped at 30% income tax and they're capped at 12% on the CGT side. So definitely beneficial there. You can nominate joint plan holders depending on the platform, multiple beneficiaries. So from an estate planning view, we definitely recommend putting that into one of those life wrappers. Then on that lump sum, in terms of the portfolios, we're not going to show you any recommendations now. You would use as per the short list in the previous slide, but most likely you would look at a combination of great equity managers like the Seed Global Equity, Old Mutual, Jupiter Merian, as well as your Fundsmith equity fund. Then in terms of strategy, when we look at that offshore amount that he wants to invest 2,000 Rand monthly, those of you that have popped onto the platforms would have seen that 2 grand generally forms well below that minimum monthly investment requirement in order to go directly offshore. If I'm not mistaken, I think Glacier has an option where you can invest as little as 5 grand a month. But for Mr. Khaleesi, what we've decided to do is we take that 2,000 Rand a month, we invest it through a list platform like Stanlib, we put it in feeder funds or what we would call Rand swap funds. And this is exposure to offshore assets. It invests into the direct offshore fund, but the money remains in Rands. Then what we would recommend after another year or two, that capital within that fund would have grown enough to meet the minimum for a lump sum into direct offshore. So after a year or two, we would take that list money, we would put it into that lump sum on that offshore platform and continue that process going forward. And then finally, it's now 17 years into the future. Mr. Khaleesi's been playing rugby till the age of 55. He is now 60 years old. He's retired. He has 5.7 million in his retirement fund. He's indicated to us that he needs 20,000 Rand a month to draw down, and he wants to leave a financial legacy for his daughter. So the solution for that is quite clear. It's the income and the growth pool approach. Now, those of you that have dealt with us before, we would have shown you that the income pool or the strategy that we go for is 3 years worth of income needs in that income pool invested conservatively. The goal for this money is that the monthly drawdown as well as fees would come from that pool. And then we take the remaining of those assets and we invest it quite aggressively to target inflation plus 5 to 6%. And the goal of that money is to ensure that their investment lasts into the future. I think a lot of clients have the idea that they hit retirement and then their money is done working for them. But when they hit 65, their money still needs to last till the age of 90, 95. So it's important that you have an aspect of that money invested quite aggressively. Now, with that living annuity strategy, if we go back to this matrix, what's important to understand is that you're going to be investing all the way from conservative, and that's that income pool, targeting inflation plus 1, and then you're going to move right across the matrix all the way through to moderate, and then moderately aggressive, and then finally aggressive. So you're using this entire strategy in order to plan that living annuity. Practically, what does that look like in terms of funds? So if we put 3 years of income needs for Mr. Khaleesi at 20 grand a month, plus around 30 grand of costs, that works out to about 750,000 Rand, targeting inflation plus 1. And then for the growth pool, generally what we recommend is a 40, 20, 20, 20 split. This will obviously depend on the client's drawdown, their keenness for offshore versus local, but this is the framework that we base it off on. And what we'd recommend is 40% of that growth pool to be invested in some good balanced funds, 20% into a good local equity manager like Fairtree, 20% into a good offshore multi-asset manager, and then finally running it off with 20% to a good global equity manager like your Fundsmith. And that's pretty much it in a nutshell. This example has been a client which you guys may come across where they're investing across the spectrum. But hopefully this gives you an idea how to take what we've shown you over the last few months and giving you examples of the funds, why we've selected those funds in the different risk categories, but now how to actually apply it to your clients' particular needs. And we obviously are here for you. If you have any questions, myself and Arjan are always willing to help you build these portfolios, help you understand the shortlist, but feel free to reach out to us at any point. Thanks, Lisa.
Thank you so much, Miguel, and thank you, Ian. I think that was really, really helpful to just practically see how we can apply the shortlist in our thinking with different clients. And if you guys need help with that, or you're like, that looks great, but I don't really know where to start, please reach out to us. Please reach out to Miguel and Adrian or myself, or anyone from the team. I don't see any questions in the chat. If you do have any questions, either for Miguel or for Ian, you are welcome to just unmute yourself and ask them or post them in the chat. Or if you think of any questions later on, you're also welcome to just pop us an email and we'll get back to you on that as well.
I'm sure, Jonathan, you must have plenty of questions, eh? JP?
I see JP.
Yeah.
Hi there, Mix. Thanks very much for that. That was awesome. Just a quick question with regard to the sort of ongoing management of the income pot and growth pot. I mean, obviously, over the sort of interim, the income pot is obviously depleting as it's being used, obviously, for the drawdowns and the fees, etc. Are you then constantly just drawing out of the is there a strategy to draw out of the growth pot all the time? Is it sort of done on a once a year or done on a continuous basis? How does that work?
Yeah, so JP, we've done a lot of work and research on this. We've looked at, do you go just into balanced funds or do you follow this income and growth pool approach? So the thinking behind the 3-year period is that no bear market has ever really lasted more than 3 years. So by topping up that income pool with 3 years worth of income needs, you'll ensure that fees and incomes only come from those funds. Then within that 3-year period, this is where the fun creativeness comes in. And we're obviously happy to hold your hand and walk this journey with you. But sometime in that period, you would need to harvest some of that growth from the growth pool and you top up the income pool. The whole point behind the strategy is that you never really draw from those growth funds to supplement an income or to pay for fees. That only comes from the income pool. So to give maybe 2 scenarios, if, for example, you put the client into that portfolio now, and 1 year goes past and next year the market does really well and we see 25% of a growth in the growth pool, we would 100% recommend to harvest some of that growth and top up the income pool to maybe even more than 3 years. But let's play the opposite strategy. Say after 1 year, next year the markets are flat, and then the following year, markets really don't do well. Now you've had 2 years of the income fund being depleted, or the income funds. We then would start to look for opportune moments of when we can draw from this growth pool. What we would hope is that by the 3rd year, you would have recovered some of those losses. But in a worst case scenario, say we have an unforeseen, and it hasn't happened before, but 3 years of negative growth, we then would have to draw from those growth pools on that negative capital and top up. But the reality is that 9 times out of 10, there's going to be a period where you can harvest some of that growth. And we at Seed Investments will assist you with that in terms of, you would on your annual review say, hey, Miguel, hey, Adrian, here's the client portfolio. Their income pool is looking a bit flat. We would then look at the growth on the growth pool and either recommend to hold off, don't harvest, or we would say, JP, this is a good time, harvest some of that growth and top up that income pool.
Oh, great answer. That's terrific. Thanks very much for that, Mix.
I don't see any other hands or any other questions. So thank you very much, Miguel. Thank you, Ian, for sharing those valuable insights with us. And then we will see everybody again next month at the last coffee session.